Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Welcome, everybody. The Vantage Point with True North Wealth Partners, Eric Susi. Glad you can join us today. Today's Friday. It's March 18th. And I guess I need to say happy belated St. Paddy's Day and March Madness. So a lot going on. Hopefully your holiday went well and enjoying the games today. So this is episode number 21. Andy, our trusted partner, he's preparing profusely for our guest to be on in the back half of the show. So you'll be introduced to our latest addition to the True North Financial Planning team, which is Eric Biddle. He's a certified financial planner. So we're definitely grateful to have him on board. Just recently came on board. And also James Gantz. I just want to put his name out there as well. He won't be on the episode today, but he's part of the team too. And obviously, since we're going down the pecking order, a shout out, I guess, to Russ Long. So for those of you, Russ Long has been a part of the True North Wealth Partners team for over like a year and a half going on now. So we have the office up in Wooster, Ohio. So for folks, if you find that office more convenient for you, for our Northern clients, Northern Ohio clients, please, again, reach out to Russ Long up in the Wooster, Ohio office. So we're steadily growing, slowly but surely, and very fortunate and blessed. So thank you all for that. So with that, we do have a lot to get into. And I do want to mention, too, another thing besides St. Paddy's Day and March Madness is Friday Quadruple Witching Day. So as you remember, I mentioned this on other calls. It's just when options, futures, and some others, things that get option expiration occur today. So 4 items, they all expire today. So trading volume, I'm expecting it to be close to around 8 billion trades today. So that will be the highest year to date. And again, quadruple witching happens 4 times a year and during the quarters of each quarter. So third Friday of each quarter. So with that said, again, the average trading volume is roughly about 4.3 billion trades year to date so far. So again, 4.3 sort of around the average year to date so far. And I'm expecting today to blow it out around 8 billion trades. So let's jump into it, as we say here, at a lot going on. So we'll touch base just on some, what's been in the news of late this week with Fed Powell. So I definitely want to cover and get into the GDP Nowcast. So GDP Nowcast is by the Federal Reserve Bank of Atlanta. And what it is, it's a projection for GDP growth, which is gross domestic product growth. So with that said, back on March 1st, they actually lowered it to 0% GDP growth for the first quarter of 2022. Then it went to 0.5, then 1.2. Then yesterday on 3/17, they revised it upward again to 1.3% GDP growth. That's based on the Federal Bank of Atlanta, Reserve Bank there. So, coming from a fourth quarter GDP growth print of around 7%, down to 1%. That's the rate of change, the slowing that we're talking about. Still positive, and we hope it should be positive. But, I use Hedgeye, Ned Davis Research, and a whole bunch of other folks for our research team here. And, we expect, 0 to 1% range. So it's going to be ugly when the print comes for the first quarter 2022 GDP growth print. So again, rate of change slowing, thus how we've talked about the economy is getting into a deeper quad 4 just means things will be slowing over the next few months, March, April, May, etc. So with that, other firms have mentioned the forecast from GDP for the yearly forecast. This is coming from LPL. LPL is another firm that we use for information. And they have reduced the full year guidance for GDP growth from 4.5% down to now only 3.7%. Again, against last year's around 6% GDP growth range, a little over 6%. So now coming down to 3.7 for the entire year. Again, slowing, still positive. Remember, so GDP growth was 1.75, 2%. On average for the past 10 years or so. So it's still north of that, over 2%. But overall, the rate of change is slowing. So I'm just mentioning how everything is starting to get tightened up. Earnings forecasts. So in the United States, we just got through the fourth quarter earnings that were released and announced here in the first quarter. So now the first quarter is buttoning up. We have today's the 18th, so 10 days or so, or 2 weeks left before the end of the quarter here for the first quarter. So a lot of window dressing does start to begin, and that's what we've seen. So a little bit of a relief rally because certainly the markets were oversold. We had nice 3 days in a row of upwardness. Today we'll see how it ends, but on Friday, but it's definitely a volatile day. But my point is this: it's still a lot of market volatility. The volatility or the VIX index definitely was last week in the mid 30s, and today it's around 24, 25. So the volatility index is still moving around. Anything above 30 is the F bucket. Anything between 20 and 30 is the chop bucket. Means it's just a lot of volatility back and forth. And then anything below 20 is easy money. So right now we're still going to have high volatility north of 20, and sometimes we'll have days of 30 and above over the next few months. So we're not out of the woods at all. And then going back to the earnings forecast, since we're getting into now the first quarter earnings, they really haven't reduced the company earnings forecast yet, all the analysts. And so that foot still has to be felt throughout the markets. So expectations are still a little high. So I anticipate things to be reduced even more. So over the next few weeks, as earnings start to announce in April for the first quarter. So I think there'll be an eye-opening to that as well. So remember, we talked about forward guidance. So forward guidance is key. And so those are just things that are on top of mind. Again, let's talk about, the Fed. So Powell spoke, and he raised rates quarter point, anticipated. So now, unfortunately, the markets still are pricing in, and the markets are expecting, and he even talked about another 6 rate increases this year for a total of 7. So, I hope he doesn't do that. The markets the economy is not strong enough, I should say, to handle that. Otherwise, we'll be going right back in, or going into a recession at some point in time, whether it's later this year or next year in 2023. So again, we're following all that. Quantitative tightening. Quantitative tightening is the Fed has about $9 trillion on the balance sheet, in addition to the $30 trillion in debt. So 30 trillion debt, and then you have 9 trillion on the Fed balance sheet. So that was the giving of the free money, the money supply that was so easy, which caused a lot of this inflation. So quantitative tightening, now he mentioned in his notes, they might be doing it faster than they did it back in 1819. The cycle back then was $50 billion per month. So now they're looking for a pace of around $75 to $100 billion per month in this upcoming cycle for quantitative tightening. That's, again, to reduce the $9 trillion balance sheet that they have. So when you add the tightening plus rate increases, I heard some Fed gentleman spoke today. I think Bullard wanted 50%, and now another gentleman's coming out saying 50%. So these next meetings, you might see a 50%. And they want to do a couple 50%, and then they'll reassess things. So tightening with major rate increases that fast is not a good sign to a slowing economy. Hence, like I've been saying all along, getting into a deeper quad 4. So we're not out of the woods at all. This is a nice little relief rally, but again, we've been positioning portfolios accordingly, and we'll continue to do so. So I just wanted to keep it real as we always do here. at True North Wealth Partners. So I guess getting into, I know the recovery tracker, we talk about this as well. So you'll see this too. A couple of good things is the ASA staffing index. So that's been elevated. So that's great. So that's, if it was declining or going a lot lower, that would be a concern. So again, companies are really leaning on staffing to fill the gaps of the shortage of workforce, folks. Another hotel occupancy is straight up, and then now springtime is right knocking on the door. So we anticipate that doing much better. Open table restaurant industry, it's doing better. And my friend who has the restaurant, so yeah, he's made it through, and hopefully he continues to do well. So that's good there. So I just wanted to share with you some of the again leading indicators and just indicators in general of how the economy is opening up. So that's a good thing. If you don't mind, let's just get into a few charts. I love my charts. They're visuals. People can retain and learn more. So that's why we go through this. So first one you'll see here is the VIX Volatility Index. I sort of spoke about already. So last week it was around 35, 38, and yesterday it was 25, and today is around 25, 24. So you'll see that elevated in the mid-20s to mid-30s over the next few months. Again, the average is 18.2, going back to 2010. So that's just what the markets, or the volatility index over the next 30 days, what they project out, and it's still going to be elevated is the anticipation there. I mentioned about the rates, how the Fed raised rates. They have the 2-year, 10-year. So the 2-year, okay, again, this is through yesterday, was about 2.2. So you can see how just dramatically has risen, the 2.2, and then the 2-year has really spiked this year, all the way up from a low of like 0.4, 0.3, all the way to now 1.94. So again, I mentioned this last month, the inversion of the yield curve, you'll hear that. All that means is the 2-year yield is providing more yield than the 10-year yield. So 2-year is higher, providing more yield than the 10-year. So that's called an inversion. And when an inversion occurs, as you'll see on the next page here, then you can go into a recession, anywhere from 9 months to, 15 months out. So it's a leading indicator. I know it's hard to see on this, but the light gray lines are the recession points. But every time that the 2-year has inverted, meaning more yield than the 10-year yield, then it's a leading indicator you'll go into a recession shortly thereafter, whether it's 9 months, 13 months, what have you. So that's just going back to history, going back to 1980, something we look at. There's many ways to dice it up. Like 2-year, 10-year, there's also the 5-year, 10-year. The 5-year, 10-year already inverted this week. Ding, 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 ding. So that's one little indicator. So again, I and most folks follow the 2-year, 10-year, but again, the 5-year did already invert this week. So yeah, forewarning is there. So that's the caution yellow flag. Next is the federal fund rate. Again, they've raised it 1/4 point, as you'll see here. So that's the first plot up. And then again, they want to raise it 6 more times. So, during 2022 to get it close to 2%. And then I think another 4 or 5 times more in 2023. You can see it going higher, getting close to, in the high 2s, 3% area. 2024 takes sort of a off that year level. And then they're going to reduce rates in 2025 going longer. So get it straight up, level, and then go down, as that's the federal funds rate, target. And you'll see that here is their dot plot. The dot plot's just to fund FOMC members as they meet and they do their projections. So this is their latest projection. And the dots represent a vote for where the voting members want to see the rates increase. So you can see this going higher as well. Then next year, higher, leveling out thereafter, then reducing in 2025 in the longer run. Moving forward, so I talked briefly about the global central banks and the balance sheet. This is global, so it's ours. The top line's the Fed's, $8.9 trillion. The point is it's almost $9 trillion. This is what they want to quantitative tightening. Okay, so they need to reduce that. You can see the big spike up, obviously COVID, and then the next leg up was this, too much spending, which led to M2 money supply and inflation and yada, yada, yada. Too much spending in general. The ECB, European central banks, They have about 8.7 trillion, and then the Bank of Japan's 731 trillion. So you can sort of see what all the other global countries are at as well, relative to our own U.S. federal at about 9 trillion. Wage growth. So wage growth, that's big. So you've heard us talk about this. So when you have consumer price index, high and wage growth high. So wage growth right now, through February is about 6.7%. That's great. Glad people are making more money, but try to keep up with inflation. But again, it gets passed down to the end users. So companies don't necessarily, they try to absorb it to a certain degree, but they don't. They always pass it down. And I'll mention that. But just wanted to share with you where we're at historically, 1990 to 2010. It's been about 3.3. Since 2010 through last year, I guess, it was about 2.9. So now you can see it spike up. So I want to keep that in perspective. And with wage growth, I mentioned in the article this week, the Nationwide Insurance Company here in Columbus, Ohio, announces they're going to increase their minimum wage to $21 an hour. So, okay, that has been announced. Great. That's nice. But then today, just coming into this, I was talking to Nathan. I forget the name of the insurance company, so I'm not going to say it. But another insurance company just announced today on CNBC and the news that they're going to be increasing their insurance premiums. Okay, so let's stop and think about this, folks. So Nationwide's increasing their hourly minimum wage to $21 an hour. Okay, when you have inflation elevated. And my point is, no company is going to sit on it all. They're going to push it all out to the end user, meaning the policy holders. So basically, expect your insurance premium rates for housing, auto, property casualty, just in general, umbrella insurance, things will be going higher. So trickle-down effect, it's not good. Just be aware of it. So the jobs and quit opening rates, so the jobs opening, this is back in January. It's a little bit more than that, about 11.5 million jobs. So there's 11.5 million jobs are out there now. And, about over 4 million people have quit their jobs because they're feeling more confident or, they demand more, hence the wage increases, et cetera. So the gap is huge. Typically the average is about 4.5 million job openings. So just, not enough people working, and there's multiple reasons for that, which I won't necessarily get into at this point, in time. CPI, Consumer Price Index, we talked about that. So it's 7.9%. So that was the print for last month. So remember I was talking about peaking CPI? Well, one thing we just briefly spoke at that was when Russia was invading Ukraine at the time. So I was saying it's peaking February, March. Okay, well, it's still peaking. So it's really March, not necessarily February. So the CPI print will be over 8%, 8.5% is what I'm hearing. So around 8.5% print. So when it gets printed for that CPI print, when it comes out in March, later on and also in April, they'll still be elevated well north in the 8% range. So unfortunately, we're still going to have, we're curling. There's certain parts are starting to decrease. So not everything's still going up, but let's just say the Russia-Ukraine excursion, the debacle there has not helped the overall situation. Oil and dollar, there's two axes here. So the y-axis is on the left. That's the vertical. And the x-axis is going across. That's the horizontal. So if you take a look at the oil, again, looking on the y-axis on the left, you can see the blue line moving up and down, up and down. So it crossed last week about almost, it nudged 125, 130, $130 a barrel. So 125-ish range. Okay, so that's what it did. And then it dramatically, you can see the spike back down. It came back down. Now it's around basically 103 range. So, okay, so spiked up, came back down, but it's roughly in the 103 range. And it will probably be in that range. I was on some calls earlier last week, this week. It's going to be in that, $95 to $115 range for a little while is what I'm hearing based on calls I've been on. And then the dollar, we've had a strong dollar. That's because of flight to safety. So everybody wants our dollar. So you can see that. That's like the gold line. Look to the right side of that. You'll see the dollar grow from $90 last year in January 2021. $90 to now hit $99, almost $100. So it moved, 90 to 100 over the past year, flight to safety. So when you have inflation all year long last year, spending too much, yada, 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 weak policies, bad policies, this is what you get, a flight to safety. So the dollar will probably still remain strong. Again, right now it's around $98, But I just want to share with you sort of perspectives of the dollar and the oil. And commodities, again, this talks about the lumber, corn, oil, copper. So you can see the charts going back to January 2020 as a baseline of 100. Lumber spiked up, came back down. Last week, it was down 19% in 1 week. So lumber is just very volatile up and down, both directions. Corn is seasonally high, so 754. So right now it's been high. And oil, like I mentioned, 103 range, copper. So there's soft commodities, orange juice, cocoa, palm oil, things like that. So certain soft commodities are peaking, other ones are still bouncing around. So again, overall inflation will still be elevated, but a lot of it will be peaking for the February, March, April timeframe. So with that, I know we covered a lot. Hopefully that was helpful to put things in perspective. We'll continue to do and manage things accordingly. I do like to end on tips of the month. We have 2 of them. So one is, tips of the month is, finally, teachers, you got your raise. So this is coming from the Dispatch here on March 17th, which is yesterday. So retired teachers in Ohio to get a small cost of living bump after years of no increase. So you're going to get a 3% one-time cost of living bump eligible retirees starting July 1st of this year. So basically, retirees who retired before July 1st, 2018 will receive a boost on the anniversary of their retirements. It will be 3% of their base pension check. So, that's good. You definitely been taking it on the chin, but they finally capitulated and crumbled down to having to do something. So just want to throw that out. Last one here. This came out in our monthly update that we do. 3 decades of college cost increases. So you can see that here. So the 3 decades of college cost increases. With that said, let me just read briefly a little bit of it. So I'm going to focus on public colleges. So basically 1991 through 2002, like a 27% increase on average per year of college cost increases per year. So that's 1991 through 2002. From 2002 through 2012, it increased higher to 50%. So during those years, the average increases were 50% higher college costs. Finally, from 2012 through the end of last year, or through this year, it's about 11%. So 11% is the average increase at that point. So again, 27, 50, and 11 for the college average costs of increases. So that's a shame. It's been very high. And again, trade schools are great. Not everybody necessarily needs to have or go to college per se, but those are things to think about. So I know we covered a lot going on. A lot of volatility will still be with us. Springtime's knocking on the door, folks. We appreciate you. I want to tee it up. Again, Andy will be stepping in here and interviewing and visiting with Eric Biddle. So we're glad to have him on board. He's an added teammate and a great planner as well. So appreciate you. Any questions, concerns, obviously reach out to us. We're here to help you. And we're doing a lot of video podcasts, webinar meetings, I should say, calls, reviews. So we try to keep things timely and informative for you. So you guys take care. Again, reach out to us if any further questions or concerns, and we will take care of you as best we can and staying ahead of the markets as well as best we can. Appreciate you. Enjoy spring. Thanks.
Hey, everybody. So Andy here with excited to introduce everyone to Eric Biddle. So Eric has recently joined us here at True North, and he's a financial planner. And I got to know Eric from a mutual friend of ours, introduced us, and we just started hanging out, talking, and so we're real excited to have him here as part of True North. And so we just thought we'd take a little bit of time here during the podcast just to kind of give him some time to let everyone get to know him a little bit, and we can ask him some questions. So,
sounds good. Happy to be here.
So if you wouldn't mind, just give us the 411 rundown or the quick rundown on Eric Biddle and kind of your background, what brought you into financial planning, and
Sure. Yeah, so my name is Eric. I am the other Eric at the firm, and I actually grew up in Hilliard. So I graduated from Hilliard High School.
All right.
Married a woman from Dublin Kaufman. So I always say that I married up on multiple levels.
We all did, man. We all did.
Yeah, exactly. Went to school at Malone University in Canton, Ohio, where I studied Bible.
Okay.
Graduated from there. I was a pastor for a few years before deciding to go back to school. So I went to Ashland Theological Seminary.
Oh, wow. Okay.
Studied there, continued as a pastor for about 12 years, and just decided it was time to exit the ministry vocationally anyway.
Sure. Yep.
Yeah, so it's funny, I used to sit in my office as a pastor and daydream about doing this kind of work.
Oh, really? Oh,
Yeah.
that's interesting.
Yeah. So I ended up quitting ministry, wasn't exactly sure what I was going to do. I wanted to do this kind of work. Ended up being introduced to a guy who ended up becoming my business partner.
Okay.
So he was in the financial services industry, owned a company by the name of Fisher Wealth Management. I befriended him. He decided, hey, sure, I'll bring you on as a financial planner. At that point, I started working on all of my licenses and got up and running, worked on my CFP studies.
Nice. Good.
And then got up and running with that, became certified. And then he exited the business. I bought him out. We changed the name to Rock Point Financial.
Okay.
I did that for about 8 years before finding the light.
That's
The
right.
light, the
That's
light
right.
being True North Wealth Partners.
That's great.
Yeah, so I was basically at that point I had been running my own RIA. I was a compliance officer. I was everything. Washed dishes. I did it all. And I was glad to be able to partner with a group like yours where could divide the tasks a little bit more. I didn't have to worry about all the business ownership things.
Yeah,
I
sure.
could just be a planner.
Yeah, great. And I hear you on that. And yeah, when you were like you said, you were by yourself, like literally in an office by yourself, right? So it's like, that could be tough, right?
Yeah.
And especially if you're a people person and, you want to be out
Yeah.
with people. And plus, I think, not that we know it all,
Yeah.
right? But it is.
Maybe we do.
That's right. It is nice to have, I know just from the time you've been here and like when everybody's in the office, it's nice to have that collaboration.
Definitely.
Right. So, hey, I'm making some adjustments to this plan or that. What, have you run into this situation or, what am I missing?
Yeah.
Things like that. So,
Oh yeah, that's so valuable. So yeah, previously I was actually leasing from an accountant. So I did have that kind of collaboration and they were an extremely valuable tool. And it was cool to be able to go down to their office and say, poke my head in and ask a tax question.
Sure.
Well, the benefit here is that not only, do I have the accountant in the office, right?
Sure.
But I've got you guys. I mean, just today, I walked over to your office and asked if you could help me with some things.
That's right. Yeah.
And you imparted your wisdom upon me. That's
I sign this form here.
exactly. But I mean, how good is that for our clients when we can collaborate?
Yeah. I agree 100%. Yeah. And that's cool. Your background is, it's like, I think we've talked about this too, where it's kind of there is a lot of correlation in a sense kind of between, not just ministry, I guess, like in your situation where, there's a lot of, it's being able to listen, a lot of the same skill set in a sense that you might use in that field. Kind of, there's a lot of parallels or skill sets that probably would make someone a good advisor who was maybe in the ministry. And so I think you see some of that where it's, you're in a sense, you're shepherding your clients, right, to a certain extent, kind of along this financial path and, to a destination. So, so in some way there's some definite parallels. So that's great.
Definitely. Yeah. You know a little bit about that, don't you?
We've had,
we have a similar background.
Mine was a little bit more on the business side, but no, I describe it the same way. I've had a lot of people say, okay, so you've gone from ministry to the financial services industry, and they say, wow, what a change that was. Yeah.
And I kind of say the same thing that, well, it really, from the pulpit, I was talking a lot about money anyway.
Sure.
In premarital counseling classes, and we were doing some financial peace university kinds of things. So we were talking about money, really, as I came into this industry, a lot of the skills, just like you said, were transferable. There's so much education in this field. Counseling. Simply pastoring people through their financial lives.
Sure.
That's exactly what it is.
Yeah. Yeah, I can totally see that. That's funny. Yeah, because there was when I, way back when I was fresh out of college, there was a church up in Toledo that I worked for. They brought me on. I did some, I was basically there, kind of running the business side of the church. And then there was a time, and there was a guy, Larry Burkett, who, he was big into budgeting. He was kind of like the Dave Ramsey in a sense of the time.
Crown Financial Ministry.
Yeah.
Yeah.
And so I got licensed through him to help people. It was just real basic, like just budgeting and all that. But it was, it was very, that kind of really whetted my appetite for, thinking, man, this would be great to be able to do this, for a living, and how fortunate we are, right, to be able now to do that. So, but, so when you think about your practice and, the planning you've done maybe up to this point, like, is there, I know you talked a little bit about your background, but what, where you see yourself, next few years, or what, like what goals you have for your practice, those types, because even though we're all together, we technically have our own, I guess, practices, I guess, to a certain extent, but
sure. Yeah. Well, I see it just continuing to grow organically.
Yeah.
The way that I've been growing just through referrals from clients.
Yeah.
Take care of the people, and you're oftentimes rewarded for that. So I would see myself just continuing to grow organically. I enjoy doing the planning piece. So I feel like I add a lot of value. We all know that we add a lot of value when we're talking through things like, okay, cash flow, and how do we get to where we want to go?
Sure.
How do we make sure you're set up for retirement? How do we utilize the various tools at our disposal? Do we do Roth conversion or not? So as we continue to grow, I see financial planning still being a very core part of what I do.
Yeah, absolutely. That's great. That's great. So what do you like to do for fun? You and the family? So your family, and so you're married and
I am.
Have kids.
Yeah. Yeah. We don't believe in fun. So we don't do a lot of that. No, I'm kidding.
It's like, that's right. All business, right?
All business all the time. Yes, I'm married to a wonderful wife. If you're listening, I'm married to a wonderful wife.
Yeah, that's right.
Right. And then I have 3 kids. We have a 16-year-old, a 15-year-old, and a 10-year-old. And so these days, mostly what we do for fun is we go to sporting events for our kids.
That's right. Yeah.
So we're involved in lacrosse and soccer and baseball and basketball, and every once in a while we get away for a vacation, or sometimes we even make it to a movie or to a park together for a hike.
Man.
So yeah, that's what we do as a family. Particularly, I enjoy hiking. So I like strapping on a backpack, putting some food in there, sleeping bag, tent, and getting lost in the woods for 2 to 4 days with some friends.
All right.
So that's my idea of a good time, is getting out in the woods.
All right. Well, you can have that. I'll stay at the hotel. I have on my watch. I have, obviously, we sit a lot, right?
Yes, we do.
So I have a watch, and it's for golf. So it's supposed to tell me like how far I am away, from the hole,
Sure.
which is, and as if it matters. Yeah. But it has an alarm on here, and it says about every 30 minutes you hear beep, and it says move. It says move on my watch. Like, get up off your seat and move. And so this is funny. So like for me, you like to go hide in the woods. Like for me, and when my watch goes beep, I walk to the vending machine, or I walk to my car. So anyhow, sorry.
Yeah, right. I mean, because you got up, you moved, you expended all kinds of calories, so you got to go to the vending machine to replenish it.
That's right. Anyhow, kind of got off the topic, but anyhow, but seriously, we're very excited to have you.
Yeah, glad to be here.
It's been fun getting to know you. I think you bring a lot of really good qualities to the team. To the True North team, and we're excited, for hopefully years of growth and good times and helping a lot of people. And so this is Eric, and feel free to say hi to him when you're in the office, and we'll put your if people want to get a hold of you, if someone maybe who's not a client, they want to reach out, obviously they can call the office, and we'll put your email maybe up on the screen too. All right, man. Well, I'm sure you'll be part of the the podcast, video cast here. I'm gonna put you on the rotation. So,
all right, very good. Yeah, sounds good.
All right. Well, thanks everybody.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss.